Hello, everyone. We are launching this event. Let's start with presenting ourselves and the presenters. We are today from 3 Baltic countries. My name is Vykintas, or Vyk in short, and I represent Lithuania. We have also from Latvia. Mārtiņš, please introduce yourself.
Good afternoon, everyone. My name is Mārtiņš, and I'm representing Thornton, Latvia.
And Estonian colleagues.
Good afternoon, everyone.
Hello.
My name is Kristjan.
And I'm Urzula.
From Estonia.
And we also have from Lithuania our VT expert, Paulius.
Greetings.
We are excited to be here today with you and present our insights into key tax changes in the Baltics. This is quite a historic event, traditional, more than 10 years already, with Estonian Chamber of Commerce notably, as well as Norwegian Chamber of Commerce, Swedish Chamber of Commerce, Lithuania, as well as in Latvia, and the German Chamber of Commerce, supported also by American Chamber of Commerce. So big thanks for all the chambers of commerce for sharing the news about this event. And we will try then today to run through all the 3 Baltic countries and represent what are changing this year. Let us start by introducing into payroll cost comparison in Baltic states. And as almost every year, we are trying to review what changes in the taxation of salaries. And this year, we can clearly see that labor taxation is the most favorable in Estonia, slightly less in Lithuania, and a little bit also less in Latvia. Of course, many other factors come into play, but from purely taxation perspective, it seems like it is most favorable to have salaried employees in Estonia nowadays. Let's move on and let us start then today by reviewing Lithuanian changes. And here we try to recap a bit what taxpayers groups saw increases and who saw decreases in their taxation. So top 5 tax burden decreases are for micro companies, then also for large machinery intensive industries who will have instant expensing possibility. Further aspect is for shares received through stock options mechanisms. The tax rate will be slightly lower than the standard rate. Fourth decrease is for individuals selling 5 years held immovable assets, which will be tax exempt and currently is 10 years, as well as will have possibility to deduct capital repairs. And the 5th element that we wanted to mention is non-taxable scholarships to researchers carrying out research or experimental development projects under 3-party agreements between company, universities, and researchers. So these are top 5 tax burden decreases that we see in Lithuania for this year. Nevertheless, as well, top 5 tax burden increases are also so not everyone gains from this tax reform, and notably employees earning more than 83,000 of annual salary will be somewhat penalized. Unfortunately, they will have to pay a higher corporate income tax rate, 25% compared to currently 20%. Then freelancers also saw increase of their taxation and making it much closer to the labor taxation than before. Commercial real estate also got additional 0.2% tax rate element taxation burden starting this year, as well as non-life insurances. They saw additional 10% contribution introduced starting this year on non-life insurance premiums, and maybe not the highest one, and it's a slight increase of 1% was to all corporate tax payers from the previously 16% up to 17% standard corporate income tax rate, and 7% the reduced rate for micro companies. But then again, as we mentioned, for micro companies, it is possible to have for two first years 0% corporate income tax rate. So it's a little bit of increases and a little bit of decreases. Therefore, we cannot really say that this tax reform is making much worse for taxpayers. There are some good things. There are some maybe also increases of tax burden. Let us review all this more in detail. So the announced goal for tax reform in Lithuania was defense funding, which is fully understandable given the context. And there are additional streams of tax revenue channeled to this defense fund. Hopefully it will be not too little, not too late, but notably this new security contribution was introduced starting from this year, which will be taxing all the property assets that are in Lithuania and that are insured with non-life insurance. 10% contribution will have to be collected by insurance companies and paid. As always, there are some exemptions for mandatory vehicles, civil liability insurance, as well as for farmers, animals, plants, etc. And this contribution will be quarterly. So please prepare. The first installment will be closing at 15 April 2026. So a couple months from now. Let's move on to see this quite many changes with the corporate income tax as well. As mentioned before, the tax rates are slightly changing, increasing by 1 percentage point. Also, micro businesses tax relief is possible now to be applicable for 2 years for companies, micro companies established starting year 2026. So this is also very, very important. And the 10 employees limit is also abolished, even though 300 euro turnover still persists. And probably it's not very easy to have more than 10 employees with 300,000 euro turnover, but at least it's no longer there. There was a lot of debate how to make Lithuanian tax system more attractive, and there were also initiatives to copy somewhat Latvian and Estonian models. But as a compromise, we have starting this year new instant expensing for fixed assets, meaning that those long-term assets acquired since 2026 and belonging to specific asset groups such as machinery, they will be it will be possible to expense them in the current year and not through depreciation periods. It is an alternative to investment projects relief, which is also existing in our law on corporate income tax, and which is more beneficial actually, as it allows double deduction, not only during current year when the expenses were made, payment for those assets were made, invoices received, but also a second time during the regular depreciation. So we will have already two alternative reliefs, and this investment projects relief is a little bit more difficult to apply than the instant expensing. So that's the main catch. Companies will be able to instant expensing of those assets not qualified for investment projects relief. Then from more restrictive side, there were some restrictions on use of tax losses. Same 70% limit introduced for losses carried from the past, and also for losses from the group, despite more favorable court decisions we have now in the legislation, that we have to analyze conditions of holding and duration in the group on the very last day of the tax year, and not on the moment of this transfer happening. Then also from more let's say favorable things to taxpayers, there were some scholarships improvements introduced. So maybe for students it is not as big scholarship, as it is only 2,500 euro per year allowed for STEM fields. But notably for researchers, it is introduced in Lithuanian tax rules that companies paying scholarships to researchers under three-party agreements between university that can be from any double taxation treaty country, so for example the United States or Japan or China or all the European countries as well, then a company must also be party of this three-party agreement, and a researcher that can be qualified as having even bachelor's degree. Doesn't have to be PhD researcher. It can be also master's degree or bachelor's degree. Those individuals will be allowed to earn scholarships completely tax-free from personal income tax, as well as for companies it will be allowable deductions as well. We have a separate, quite extensive press article on this new, very novel topic, and we'll share the link with you together with the slides that we will share after this event. So feel free to consult this more detailed article if this is interesting to your company. Then we had a lot of changes in Lithuania with the personal income tax, and it got suddenly much more complicated than it was already quite complicated before. The main takeaways are that progressive taxation is introduced, let's say, more, and we will have three different tax rates for income together with salaries and similar income taxed together into whole bracket. and for persons exceeding 36 average salaries, which in terms of euro is around 83,000 per year. Those salaries and incomes until this amount will be taxed by 20% personal income tax, but all those above this threshold will have to be taxed with 25%. This part of income exceeding 83,000 euro per year. And furthermore, if for high earners more than 138,000 of revenue, the 32% tax rate is introduced. The rules are quite complex, and despite those higher tax rates for salaries, note that, for example, still 15% tax rate will be always applicable to dividends, disregarding of their amounts, as well as sale of 5 years retained shares, payouts from investment accounts, life insurance and pension savings benefits for which the tax exemption was used, etc., etc. So still quite some types of income are enjoying this lower taxation, as well as farmers. They have lower tax rate, which can be 15% up to 138,000, but 20 above this threshold. As well as the so-called business certificates, verslo liudijimai in Lithuanian still persist. So this whole picture of personal income tax is indeed quite complicated, and it is not so easy to summarize what it means in reality. We try to build this with a visual representation that if you have dividends and some other types of income, then they will fall always into this bucket of 15%. Then if you have interest, rent, other non-employment income, then depending on the amount, you can have 15% tax rate or 20% tax rate, and for salaries, freelancer income, it can never be lower than 20%, and depending on the amount can only be then 25% or 32% even. So all in all, it is quite complex. But then again, a lot of reliefs, a lot of other things, such as micro enterprises that we already saw the boost of establishing of new micro enterprises starting this year. So clearly there are some possible ways for individuals to try and plan their taxation as well. It is also very nice to know that finally the Parliament adopted also a relief for stock options if held for 3 years. Then upon subsequent sale by the individual, those will be taxed by 15% tax rate, and hopefully it will also allow companies to use this mechanism more. Then, as I mentioned before, for immovable assets held for at least 5 years, this sale is completely tax-free, which previously was 10 years, much longer period. And also, for example, if the asset is requiring reconstruction or capital repairs, then it is also possible to deduct those expenses as well. So that's maybe pretty much it about personal income tax. That are the new things this year. Just a reminder, additional. This is not completely new. It was already introduced a year before, but during this year, we got more clarifications from Lithuanian tax authorities around how they read the investment accounts, the deferral regime for individuals. And why we are talking about it now is also that you have time until 1st May when you will be declaring, if you are Lithuanian tax resident, and when you will be declaring for past year 2025 to designate what accounts you deem as being those investment accounts, and income inside of this account will be tax free. As long as it is interest or similar income, or selling of some financial instruments, then it will be tax free. Only dividends are still being withheld, and this is treated as outside of scope of this deferral. And important to note, crypto assets, more than 10% of shares in a company, non-public issue shares or bonds, etc., they are also outside of this mechanism. So you have to be quite careful to analyze what's inside and what's outside. And if you have any questions, do not hesitate to contact us. And let's then move on to real estate tax. And despite a lot of debate for individuals, it's a mixed picture, and some individuals even saw a decrease of their tax burden due to higher exempt amount of 450,000 euro. But a key takeaway for businesses is that this additional 0.2% tax rate component is applied for defense funding. So for those companies having a lot of real estate assets, that tax burden will definitely increase this year. And now about other changes in VAT and excise duties, I would like to ask Paulius to share.
Thank you, Vykintas. So continuing our presentation from indirect tax perspective, the changes that are worth mentioning are mainly related with the changes in the reduced VAT rates in application, the legislatory provision transition, and tax authorities' position regarding the exemption from VAT of financial services, and of course excise duties implication for non-alcoholic sweetened beverages and beverage concentrates. So as of January 1st of 2026, the reduced rate of 9% was abolished and was increased to 12%, and is applicable only on the supply of accommodation, passenger transportation, and attendance at art and cultural events and installation services. I would like to point out that there is somewhat of a transitional period in the application of 12% VAT rate for these type of services. For instance, if the actual reservation of accommodation services occurred prior to January 1st, or for example, payment for cultural events occurred and before the beginning of this year, the 9% VAT rate is still applicable, even though the actual supply of the service occurs throughout this year, for example. Following these changes of application of reduced VAT rates, 9%, since 9% was reduced and still will not be applicable for additional supplies. As of the beginning of this year, the supplies of heating, firewood, and hot water are taxed with a standard VAT rate of 21%. This is for the better of the WOS, affects the suppliers that are dealing with the supply of heating goods and services that affect end customers alike. The position changes in VAT rates would be that January of books and non-periodic information publications, 5% VAT rate is applicable. I would like to note that due to the changes in VAT rates, there are also changes in VAT liabilities, such as submitting VAT returns and the staff registries, which implicitly affects the data submission necessities. Regarding the changes in law on VAT and its provisions that regulate the exemption from VAT, the financial services, are more like of legislatory nature, since Article 28 of Law on VAT was expanded by including the provisions stating that services of administrative, physical, technical, or similar in nature, which do not change the legal and financial situation of the parties of the transaction, are excluded from the exemption from VAT. This provision was included in exemption from VAT prior to the beginning of this year, but it was included in a ministerial order, not in the law itself. And of course, it was implied by Court of Justice as well prior to the beginning of this year. However, following these changes, Lithuania's tax administrator updated the extended commentary of VAT law, especially the Article 28, and provided quite an extensive list of services which would be categorized as financial services, and for which VAT exemption would be applied and for which ones would not. Of course, this extensive commentary indicates that Lithuanian tax authorities are prone to a more in-depth evaluation of financial services and their content. So it would be advised to, especially for businesses who are dealing in purchasing or providing financial services, to review their service packages and to align it with the Lithuanian tax authorities' position. Going further with the changes in indirect tax in Lithuania, from excise duty side, next to annual increase in excise rates that are applicable for gas, tobacco, or alcohol products, main change would be a new excise duty for non-alcoholic sweeteners, beverages, energy drinks, and beverage concentrates. This excise duty will be applicable in cases when such goods will be produced in Lithuania or acquired in Lithuania, brought from other European Union member states, or imported from third countries into Lithuania for business purposes. Such businesses who are dealing in purchasing sweetened beverages or beverages concentrates and bringing them from other EU member states to Lithuania, or producing them in Lithuania, has to register with the Lithuania's tax authorities and, of course, provide monthly excise returns.
Thank you, Paulo, for this briefing on VAT and excise duties. Final remarks from Lithuania is also beneficial, is a positive thing that we got advanced pricing arrangement introduced into the law on tax administration, and as well as a bilateral agreement between two countries is also possible, which is very useful then to mitigate the risk of double taxation, and we clearly recommend taxpayers to consider this beneficial instrument to mitigate risk, as we see that in Lithuania, indeed, tax inspectorate is more and more strict on reviewing transfer pricing, and it is indeed very time extensive then to to mitigate this risk after the fact. But this is all from Lithuania that we wanted to share with you today. I would like to pass the word to Latvian colleague Mārtiņš.
Yes, thank you, Vic. So I will introduce you with the main changes in Latvia, and we will start with the value-added tax. I would say that compared to other taxes, there is not a lot to say this year. First changes as Ministry of Finance in Latvia has presented are more related to geopolitical situation. And from the 1st January 2026, VAT on books, magazines, and press, not in Latvian or EU or OECD languages, increases from 5 to 21%. Next increase is like a pilot project from the 1st July 2026 to 30 June 2027. It will be applicable for essentials like bread, milk, eggs, fresh poultry, and there will be reduced VAT rate from 21 to 12%. And the objective of this changes is to reduce the impact of rising food prices on residents and well-being. So it is expected to lead to a reduction on the baseline prices of the covered food products, and including also in comparison to other Baltic states. Next, we will move to corporate income tax, where we have more changes, more interesting changes. First is related to dividends. We have a new tax regime introduced for companies owned only by individuals. There is now possibility to pay 15% of corporate income tax and 6% of personal income tax on dividends. And I will brief you a bit about the background why such a changes was introduced, and the amendments are designed to rebalance the overall tax burden for dividends received by foreign individual investors, and to increase Latvia's attractiveness for the direct investment by individuals. Because under the existing corporate income tax system, we had to pay only corporate income tax, and there was no personal income tax applied. And therefore, for foreign individuals, they faced the situation where they had in their country of residence, and in practice, they didn't pay any personal income tax in Latvia. Therefore, there was nothing to credit from Latvia to their residence states. But now, when there will be this, when there is this new regime introduced, and there is a 6% of personal income tax possibility, it can be credited then in the individual state. There is also a small table where we can see the difference on the existing regime we had before, where the total effective rate was 25 and is 25%. And in alternative regime, we see that the effective rate is actually lower, 23.7%. Further, we will move on to interest. I need the same slide, sorry. Yeah. So next is about fin capitalization rules. I believe many of you have heard that in Latvia we have fin capitalization rules applicable, and under this regulation of fin capitalization rules, we had already some exemptions, but starting from this year, there are even more exemptions available. So new exemptions include interest on financing raised from tradable securities, crowdfunding platforms, licensed investment brokerage firms, alternative investment funds, But what's important, it is not applicable if it is transactions between related parties. Also, it is worth to mention that the public-private partnerships, special purpose vehicles, are now out of scope of fin capitalization rules in Latvia. And the objective of these changes is to broaden access to non-alternative financial, non-bank alternative financing and reducing the financing costs for the taxpayers. Then there is also port authorities become corporate income tax payers in Latvia. So let's move on to the next slide, please. Then there is most important changes in 2026 that is related with transfer pricing. And this first slide will be with the more positive changes. So if we look at the local documentation, previously a local file had to be prepared by the end of the financial year. If by the end of the financial year the related party transactions amount exceeded 250,000 euros, but did not exceed 5 million. And if it exceeded 5 million, there was a mandatory submission of local file in Latvia. But now, after the changes, local file must be prepared by the end of if by the end of the financial year the related party transactions exceed 250,000 euros. But there is no mandatory request to submit it to tax authorities, even if it reaches 5 million. So the local file now must be submitted only upon request by the tax authorities. And the same principle will be applied also for global documentation or master file. Before it had to be submitted to tax authorities if transactions exceeded 15 millions or turnover of the company exceeded 50 millions and related party transactions exceeded 5 millions. And under the new rules, a master file must be prepared if the transactions exceed 20 millions, but again, there is no mandatory request to submit it to tax authorities. It should be submitted only upon request from the tax authorities. Then there is also good changes regarding transaction threshold. It is increased from 20,000 to 90,000 euros. So now we have equal situation as Lithuania. Then we can move to the next slide. Then there is some changes that I would not call so positive anymore. But tax authorities have introduced a new requirement, which will be filling a controlled transactions report, which actually can be prepared only if the properly drafted local file analysis will be prepared. The controlled transaction report is in generally it is a summary of each controlled transaction, and controlled transaction report must be prepared and submitted if in the reporting year the transactions exceed 250,000 euros. And so it must be submitted by the upcoming year within 12 months after the reporting year. Then there is also very detailed information that must be included in this file. We can maybe switch to the next slide. So I have copied part of this new report from the tax authorities electronic declaration system, and there we can see the what kind of information they are willing to see, which is type of transaction, total amount, TP method, apply source, market price indicator selected, market price interval, market price indicator applied. So we see that the information that usually we find in TP documentation will have to be included in the summary file. And the objective of the tax authorities was to reduce the administrative burden to the taxpayers, but in our opinion, this will not be achieved, and the administrative burden will increase. And since if the transfer pricing documentation will not be prepared, the control and transaction report will lack the input data, but the obligation remains to submit it. So in general, the TP documentation will have to be prepared anyways. And of course, there's also fines if the poor quality preparation of this report will be, or the failure to submit this report, then there can be penalty of up to 100,000 euros, which already was previous to the transfer pricing documentations. But if you look from the tax authorities' point of view, then this will significantly increase their ability to analyze the data and to identify the risks related to transfer pricing. So we can move to the next slide, and there is about application and timelines. So these amendments are in force from the 1st January 2026, and these rules apply already for 2025. And it means that the first controller transaction report will have to be submitted by the end of this year, by 31st December 2026. So in case you need any assistance, advisory, or our help with the TP documentation, we will be happy to assist. And we can move forward to the next slide, please. Yes, then there is a personal income tax. Not much to comment also from personal income tax perspective. First is that non-taxable minimum has been increased from 500 euros to 550 euros. And the next is related with dividends, as I already mentioned in corporate income tax slide, that there is now alternative option how to pay tax on dividends, and there is now option to pay 15% corporate income tax and 6% personal income tax. So we can move to the next slide. I will briefly run through other changes we have. There is some increases for lotteries and gambling fees and tax, like for slot machines, bingo, interactive gambling. Then there is also excess duty gradual rate increases for alcoholic beverages, tobacco, non-alcoholic beverages, coffee, and others, and it is through 2026 and 2028. There will be some increases also in natural resource taxes for peat, sand, and sand gravel, and new rate will be introduced for unprocessed wood obtained in Latvia. Then there is also changes in law on taxes and duties, which is new reporting obligation for crypto asset service providers, which is wider known as DAC 8. And DAC 8 is a reporting framework to provide tax authorities with information on crypto asset transactions and sellers behind them, helping to prevent tax evasion. The reporting obligation apply mainly on crypto trading platforms and intermediaries of these platforms. And the forced reporting will be in 2026, for the year 2026, by the 30 June of 2027. And of course, there will be also fines up to 40,000 euros for late filing. Please, let's move on to the next slide, which is my last slide today. This is about electronic declaration system. We have some changes. As of 1st January 2026, the access to the electronic declaration system of tax authorities will be only possible by using a secure electronic identification tool, which is Smart ID, a signature, or internet banking authentication. And non-residents will be allowed still to use a username and password, but for non-residents it is important to remind that a password must be changed at least every 90 days, otherwise account will be blocked and you will have to contact the tax authorities to get the new password and access to the electronic declaration system. Thank you. And I'm giving the word to my colleagues from Estonia.
Yes, hello. Here we are again. Maybe as an intro, I would say that I think all the participants from Estonia have already realized how different actually the Baltic tax systems are if we compare with each other. It's a very clear that we, for instance, Estonia is a unique country with still having only country having one single fixed non-progressive income tax rate for individuals and one single corporate tax rate for corporations. So, but yeah, it's of course debatable. Is it good or is it bad? Another intro remark is that actually all those details about the Lithuanian, Latvian, and now soon about those Estonian changes, you will see and find not only from a webinar recording later, but it will be published soon in each member firm website, the joint PDF detailed overview with even much more details, and for all the participants we will send the notification soon after this overview has been published and uploaded to our websites. So it's quite convenient later to find the more details and also all the relevant contacts from each country. But anyway, let's proceed further with the Estonian changes, and I will firstly give a word over to my good colleague Urzula, who will walk through you about the changes, and then at the end we will go through also some interesting information and statistics from the tax authorities. Please.
Yes, good afternoon. So I will tell you about tax changes in this year, and I'm very happy to say that the so-called tax festival is over now. As you might recall, we had the past couple of years quite busy. There was a defense tax on the table, then the car tax was introduced, and in relation to that, actually the income tax was supposed to increase by 2%. But last year, in December, the government decided to cancel the income tax increase. So the income tax rate is still a flat 22% for both individuals and legal persons. Another minor change in Income Tax Act was the extension of tax exemption for the donations to support Ukraine. As in Latvia, the tax exemption means that in Estonia we don't tax certain costs, or we tax certain costs with corporate tax. So if you are donating for Ukraine, then these kind of expenses are not taxable with corporate income tax. We can move to next slide. But the major and positive change as of this year is the abolishing the so-called tax hump, which was in force for 8 years, which meant basically that we had a regressive basic tax exemption or non-taxable minimum, which meant that if your income was low, then you had the basic tax exemption, but when your income increased, the basic exemption decreased. So to the point that when you had a salary more than 2,000 euros per month, then your tax exemption was 0. But now, as of this year, all people have a non-taxable minimum 700 euros per month. And this is applicable to Estonian residents as well as the European Economic Area residents who are receiving taxable income from Estonia. So there are 2 ways how to apply this exemption. The first one is you have to submit an application to your employer or the tax withholder that you want to use the basic exemption when your salary is calculated. If you don't submit an application to your employer or the withholding agent, then the other option is to use your exemption by filing your individual tax return. It is a quite major change because, as you saw on the first slide, which we showed us, it has made the tax burden on salaries a little bit lower. So with this change, for example, average salary earners receive more than 150 euros more at hand every month. So, and more details you can see from our article, which we have copied here. So you can access later and see more. And there are no changes in value-added tax, actually. But just to remind you that the VAT rate increased 6 months ago to 24%, and it was also related to this Defense Tax Act, which was supposed to raise income tax liability also.
Yeah, as a kind of quick side comment, differently from the last VAT rate increase, where rate increased again 2% from 20 to 22, then we had some transitional measures available for some type of civil transactions where the rate was specifically agreed with a previous number or rate. Then there was a possibility to apply the lower rate at some extended period. But this time, after the new, today the valid 24 rate applied, became into force, we abolished all such transitional measures. So there are no possibility whatsoever to apply the previous lower rate. So it's a standard rate for all transactions, 24. Of course, we do have also the reduced rate as also in Latvia and Lithuania, but those lower rates, reduced rates are a little bit different between different Baltic states and applies also for the different goods and services. And the technical change about the 27 listed here is yeah, it's more like to provide more clarity. They pretty much after those changes, they will abolish different side reports and consolidate all this intra-community and domestic statistical information into subsections of main return. So that's not like much, nothing in reality changed, but yeah, hopefully it grants a bit better clarity for the taxpayers as well. Yes, I think we can move on.
Mm-hmm. So we have also some reliefs from motor vehicle tax or a car tax, which was adopted last year. So retroactively, the parents got a relief, 100 euros per child, which was calculated by the tax authorities very quickly in December, and the excessive tax was refunded to the taxpayers. So basically, if a parent has a child, then the motor vehicle tax will be discounted, and the discount will be applied automatically, so the taxpayer doesn't have to submit any applications or make any filings. Also, the tax rate and the registration fee for minibuses was decreased. So it means that for the vast majority, the car tax would be 50 euros per year. As you recall, the car tax consists of two parts. One is the registration fee, which is paid when the first registration is made or the first owner change is made. And then there is an annual tax, which is calculated based on the car. So the next slide, there were also some reliefs on the tax period when, for example, the car was deleted from the register, then it makes no sense to pay the car tax for the whole year. Then the period is shortened. And also when the car has been stolen, and all those corrections are also made automatically. And as a reminder, we have still a lot of so-called phantom cars in registers. Until last year, the entries could be deleted free of charge. But as of this year, the state fee is 15 euros to deregister such car, which is dismantled or lost somehow. But as from next year, the state fee will be already 800 euros, plus you would also have to start paying car tax for those cars, which are actually not existing anymore, but still registered. And some minor changes also in land tax, but these land tax rates did not change. But what changed was the possibility for local municipalities to establish a limit on a land tax increase. Previously, it was a national-based limit, which was 50% or 20 euros, but now local governments can establish the limit by themselves. And also the homeowners tax relief, which was also national-based and it was area-based, is abolished, and now the local government will decide the relief amount. It could be 0, it could be up to 1,000 euros. I checked from my local municipality. My land tax increased significantly and there is no relief. So it depends on which area in Estonia you live. The next slide, please. And also, as Mārtiņš mentioned, there is a new directive on administrative cooperation, TAC 8, which was adopted actually at the end of 2023, but it's in Estonia, it's still not transposed to local law, but it will be transposed, it will be implemented retroactively, and it means that the crypto asset service providers must start collecting information already about the identity of the platform users and their purchases and sales and so on. So first, the declaration must be already submitted by the end of June next year, and the countries will start exchanging information by the end of September next year. With this draft bill, also there is a significant change in fines, because so far when the taxpayer didn't submit documents or hindered any way the activities of tax authorities, the maximum fine was 3,200 euros. But by this draft bill, it is proposed to increase this fine to legal entities to 50,000 euros. I think this is, yes, and of course excess duties, they are always increasing because we don't want to consume alcohol and tobacco products. But of course, excise duties are also taken from electricity and fuels, and unfortunately these are also increasing. But you can see a more detailed list and table from our webpage, which is also listed to this copy to this slide.
Ursula, quick questions about crypto. The last slide, how it is now, the trading, individual crypto trading, the losses from that is now also offsetted, deductible?
Yes, yes, as a reminder, as of 2025, the losses from crypto trading can be now offset with the losses of crypto profits. Until now, it was impossible to offset the losses, so only the profitable transactions had to be reported and tax paid on it. And as of now, also, as of last year actually, also regulated crypto asset providers, the crypto assets which were bought from regulated asset providers could be switched to the investment account system.
Yeah, so the outcome was or is that more diligent traders actually moved these assets to the companies to be able to offset, so we are more safe. But here, of course, those traders who are like to playing dead, so to speak, will be now exposed to this directive and exchange of information soon. So
exactly, yeah. Tax authorities will have information on the trades.
Okay, good to know. Good to know. Let's move to this chapter. Actually, we would just like to give you kind of insight, a bit insight of the tax authorities' work field. This following summary is based on the tax authorities' own recent in-depth statistics shared through the regular tax professionals and tax authorities cooperation format. And as you can see, they are very busy, and maybe also context information for listeners from Latvia and Lithuania here. Due to the changes of working methodology, Estonian authorities generally no longer initiate the kind of comprehensive audits where the inspector doesn't know exactly what exactly we are starting to investigate, coming in and spending 1 or 2 years, as it was actually quite a lot before. Now, instead, they are focusing the reviews of specific issues, both in direct and indirect taxes. Today, it's more direct, as well as larger financial impact situations. For instance, like residential property acquired for mixed use to a private holding entity. Which may give a kind of raise of different tax liabilities. So this helps them focus on what is more important and also work through more cases. So that's the background. Now, about this slide, one thing that we should emphasize is the data-driven approach, because the automated AI-driven cross-checks and analytics flag risk cases. Inspector still inspector makes the final decision on whom to hold it and how to proceed, but the pre-selection is fully automated now. And based on the tax authorities' feedback, the AI results have proven to be actually more accurate and higher quality, not just more efficient. So, and we have a lot of data points which we're actually using, not only the returns, but we are comparing it with publicly available financial reports and a lot of other stuff. So and we can actually, as a tax advisors and having more than 1,000 active clients, we can actually feel this. So because a lot of those inquiries, we are very efficient. Often in the beginning, we don't waste time of preparing and starting like a formal investigations. It's often we are just sending a polite email to the taxpayer with this specific issue, and often it's quite easy thing to solve. It's not deliberate. It's not just often a mistake, but those mistakes, correcting those mistakes, could often means also that the tax burden, of course, will arise. So what else here? Also, the focus is on the foreign groups and structures. There is a reference to the different information appendixes and situations. We're using the CBCR notification very much to find the investigation sample for the transfer pricing, for instance. And the cash pools also are like very widely used, of course, globally. And if you have a tax, if you have a cash cow here in Estonia belonging to the larger global international group, for sure the group financial team always they will try to involve and add the local Estonian taxpayer to the cash pool group. And on the one hand, it's not prohibited, but there are a lot of details and risks involved, not just the rate itself, but how it has to be reported, how such reporting has to be set up, and etc., etc. Because similar to Latvia, we have this deferred tax system, so there is always a risk, and this is a focus also for the tax authorities, that if you don't pay any tax on earning the profit and then later lending out the money to the shareholders outside of Estonia, then clearly there could be the risk that no one will actually pay eventually the corporate tax. So we want to be very sure whether it is actually the loan, is it a cash pool or anything else, ordinary investment loan or credit facility loan, whatever. Bullet type of loan also allowed in principle, but they are actually digging in very, very much to look whether they can actually reclassify it actually as a hidden profit distribution. So about the permanent establishments, they are also on the focus of Estonian authorities, and with the permanent establishments, and it's a bit same also with Latvia, I guess, who has a similar type of corporate tax system. Those deferred corporate tax rules might be difficult to interpret and apply for the headquarter and local branch models to find the right method to determine appropriate corporate tax base. And often it's even more difficult to determine the right timing of a taxation of a local PE. It might be quite different case by case, depending on the business model and accounting reporting principles. And for Estonian and Lithuanian listeners, also be very careful and cautious and consult always with Latvian colleagues if you have a PE in Latvia, because they have very specific local domestic corporate tax rules which will not follow this separate entity approach in the model tax treaty. Even though all the transactions are at arm's length according to the transfer pricing principle, still different type of service fee cost. Service fees which Estonian or Lithuanian headquarter has to invoice, because if they are doing something in favor of a Latvian PE, they really have to invoice that based on the cost plus or any other method. But some of those costs will be taxed according to the domestic Latvian rules, even if they are at arm's length. So be careful with that. And the last point here is the real estate structures. It doesn't matter if it's a PE or not. Often it's more like a local special purpose vehicle. But if a foreign shareholder is selling the shares of the Estonian private limited company in general, it's tax exempt, the capital gain. However, Estonia has free right to tax the capital gains if such company is so-called real estate company. It means 50% or more of the balance sheet is real estate registered in Estonia. So in those cases, or the liquidation of such company could give opportunity to Estonian tax authorities to raise the money actually quite a lot, because such transactions could be quite high value. Okay, let's move on. Yeah. So about the dividends, as you know, the dividends, the formal dividends are the most typical corporate tax event in Estonia, and the largest, of course, because we have some other type of costs which are also taxable. Some of them Urzula mentioned, but dividends by nature and by amounts, of course, are the largest. And as you know, we have often different legal structures. Dividends are very, very rarely paid by one single company directly to a final UBO, well, a local final individual tax resident. There are always the Estonian taxpayers as a companies receiving dividends from other investments from other subsidiaries in Estonia, or from the Baltics, or from other European countries and outside of the European countries, and so on. So we have quite different legal structures, and the accuracy of declaring the dividends, incoming and outgoing, inbound, outbound dividends are foundational, because the payer recipient chain must reconcile. That's very, very, very important. Otherwise, the exemption on redistributed dividends may not apply, and it could be just minor mistakes. And if it's not done correctly, then it could likely occur the double taxation, and no one wants to have this situation. Also, there are some misapplications still, as now Latvia introduced actually the same reduced rate system as we had before, which was actually abolished already as of beginning of last year. But the problem is that I believe it is or will be same in Latvia now, that between corporations you will pay only this reduced rate corporate tax, and in the final layer of a legal entity, when the payment will be done to the individual, you will withhold additional income tax. And we have a lot of situations where such reduced rate dividends have been parked, so to speak, into this legal structure somewhere in the middle. And now, after it's abolished, somehow the taxpayers will pay it out to a final individual shareholder without withholding the income tax. So they haven't understood correctly what this change has actually, what is the meaning of this change. So we have a lot of mistakes here. There are also here oversights in buybacks, share buybacks and equity repayments. There are both lack of awareness and deliberate fraud also here, but also reclassification debates. What was the primary purpose of equity payment and other related transactions? So that's always the case. Hidden profit distribution. So that's the kind of substance over form approach to intragroup loans, substance test to the actual direction of the cash flow and its terms resembles a dividend. And it's also some cases are quite black and white, but we have a lot of gray also. And in these cases, the taxpayers must be quite cautious. And often, of course, they don't have much to say if it belongs to the large international groups, which will force them to take out those loans. But then please always consult with a tax consultant. And if we are also the auditor, even better, we can help you to stress out those risks and write on behalf of you to the group representatives, and sometimes it actually helps, or at least you will mitigate your own individual management board responsibility. Because in Estonia, the first 4 years are quite flexible on those loans, but after the 4 years, the reclassification risk will arise significantly. Yeah, and it's much more complicated, much more complex and risky and tricky, I would say, with Latvia, because they have copy-paste a little bit the same approach, but not so robust, not so simple, not so straightforward. They have like 4 or 5 different criteria, in which case such loans are not taxable. It's kind of vice versa logic. So you have to be like a very, very concentrated to understand in which cases it is actually taxable. So if you have a loans, outbound loans from Latvian subsidiary up to the Lithuanian or Estonian sister companies or the parent company, then please again consult carefully with our consultants or any other tax professionals, because the test itself could be quite substantial to give a kind of, to form a concrete opinion whether such loan is subject of so-called hidden distribution tax or not. So let's move. Transfer pricing, always, of course. And as you can see, we have a lot of cases, ongoing cases. There are 4 larger assessments. Often the most typical case is always, of course, the loans and loan interests. And as it is also mentioned here, you have to be able to be ready to defend the domestic versus cross-border comparables, especially if it can be treated as a secured loans. We have a court practice, and the tax authorities can easily rely on the publicly available data of Estonian credit institutions. And another thing is if it's a non-secured loans, then yes, we can use the foreign databases, but in case of a financial transaction, same with royalties, intellectual property, royalty rates, we can test it, we can analyze those, but those comparables are from US, North America, because such data is not available actually here in Europe. And then it could be quite risky to be able to actually convince Estonian authorities that such data is actually is meaningful and it can be applied. So what else here? Also, please be aware about very different thresholds, documentation thresholds and details across Baltics, especially with Latvia now. Mārtiņš already explained, and you can later concentrate into the details also after you can get access to this joint overview. In Estonia, the thresholds are relatively high. We have this company-wide SME thresholds, which is easy to remember and easy to apply, which doesn't mean that you don't have to be able to you still, if you have a significant or meaningful related party transaction with a meaningful amount, of course, the taxpayers should have economic analysis in place, but it's not actually regulated how detailed and how much and how detailed this documentation should be. But because of Lithuanian and Latvian thresholds, it's a risky, especially if there is a kind of group level financial function here in Estonia. Thresholds from Estonian standpoint not exceeded, then it's we have a lot of cases where actually there is missing economic analysis, missing benchmark, or missing policy, or missing documentation even from Latvia and Lithuania, because for Estonia we haven't had a necessity to have it. And also now this new reporting requirement in Latvia, which on the one hand you have plenty of time till the end of 26, but it actually applies for the 25 transactions. So if you haven't had any documentation for the transactions between Estonia and Latvia, and in total those transaction volume, which also includes the loans, are more than 250k per annum, and together with loans it's not actually difficult to exceed, then you have an issue, because yes, you may do those benchmarking analysis to be able to fulfill and submit this new report correctly, find the right method to the functional risk analysis, to the benchmarking study and everything else. But you may realize at some point later this year, when you have done that all to fulfill those Latvian new rules, that actually your own 25 profitability is not in the line of those results. So I would say, please be diligent and analyze and map and double check your transactions with Latvia as soon as possible. Because if you realize the mismatch later this year, then the 25 is finally closed and annual reports submitted, you have screwed, so to speak. It's a bit difficult to do anything retrospectively anymore. So that's all for the transfer pricing, and I think we have probably one last slide from Estonia, reorganizations and individuals. That's something, reorganizations, we have much more clarity on the one hand for the corporate taxpayers. We have a lot of new guidelines, debt push down for the debt push down, and not only published by the tax authorities, and we can already navigate better. There is a higher risk area. You can't use anymore so easily all of those commercial law registration reorganization vehicles, so to speak, like demergers and mergers, and which usually should be tax neutral. So there are some limitations, and you have to be very careful that we are talking about reorganization of a business. So if you have SPV, everything sold out, the development SPV, and you will just reorganize and restructure the cash and free retained earnings across the group, then it's not the reorganization of a business. And in that case, they can easily reclassify as a profit distribution, either profit distribution or the liquidation. In both cases, it will trigger the corporate tax exposure. But we have much more better clarity. What are the arguments and preconditions where we can actually say that, and what should be done in order to avoid that. But now the biggest issue and the fresh newest issue is for the individuals. Namely, we have had from the beginning of Estonian corporate tax or income tax law from the 2000, we have a very specific legal clause available for the Estonian individual tax residents. That's a non-monetary contribution. Basically, law grants opportunity to decide individual entrepreneur that he or she don't want to continue as a private entrepreneur, as a private investor, and would like to reorganize and reallocate his or her assets in tax neutral manner to the company. That's been very useful because often if you will do exit at some point, we have a lot of cases where those individual UBOs who have to agree and have this exit have actually realized that they actually own directly those shares, and then we are trying to do such kind of reorganization. And it's been acceptable. It's been kosher, so to speak, previously. But now, according to the new guidelines, even though the legal logic is quite debatable, but still now the issue is that we are like, as there is a last bullet point here in this slide, the tax authorities, if such parking or reorganization has been done relatively before the actual exit of those shares to the third party, they will, doesn't matter that this holding entity will not pay out, it's not going to be used for the private purpose, and etc. Business will continue as such, even though they will actually reclassify that as an individual capital gain, which should be taxed and declared as individual income. And that's a new problem. It's not so much a concern for the Latvian and Lithuanian investors and participants here, but it's actually quite a big issue right now, nowadays here for the Estonian UBOs. So that's all for us about Estonia. We'll give a word back to Vykintas, please.
Thank you, Kristjan. Thank you, Mārtiņš, Paulius. Also, thank you everyone. We'll share the slides, and you will have our contact details as well. Now, I was sharing the slides, hence I don't know whether we have some questions that we may be able to take on the spot. Probably will not be able to answer all of those as of now on the spot, but we'll try to follow up after the event. Those who will leave the contact details so we can follow up and reply. If I filter unanswered questions, there are some questions relating to Estonia. And question sounds, what are the plans for 2% defense tax implementation in Estonia?
Yes, that was explained already by
In the
Urzula at the beginning
beginning,
of
yeah.
Estonian presentation. That's abolished fully. There are no defense tax element either from a VAT, corporate tax, or individual income tax perspective. So no defense tax whatsoever, fortunately.
All right, so it seems we do not have unanswered questions, and some questions were answered. Are there any comments, Mārtiņš, Kristjan, Urzula, from your side, or are we to close this event now?
Yeah, no. Actually, from Estonian perspective, it's already the second free of charge webinar for our good clients today. So we really hope that you have been enjoying this information and it's useful. And yes, please definitely check our website. We have much more information available and will be even more available. You can even find the tax system comparison section between countries across different tax fields and etc. And you have a contacts available, and don't feel free to contact us for sure.
Mārtiņš, any thoughts
Yeah,
from your side?
I can just add that I think there is quite important changes throughout the Baltic countries, and for a lot of changes, it's always better to consult with experts how to proceed, and therefore we are there for you and always ready and happy to assist you.
Thanks. It was very interesting to hear from Estonia how deep and technical tax authorities are going into, and maybe ending remarks from Lithuania. Of course, it is going into more and more tax audits. The current debate, however, I would say focuses more on interpretation of tax legislation, and we have quite many cases where tax authorities have a different interpretation of the tax legislation than is written in the law, and a lot of debate is going on how to read the tax law. So most likely it will lead to more tax disputes in courts, definitely. And hopefully there are instruments like binding ruling request and advanced pricing arrangement where we can seek some more clarity, and if the answer is not in line, then it is also possible to go into courts as well. So most likely we'll have more tax disputes in the future, but the overall picture is of strengthening of tax administration. We are here to help taxpayers to help finding the balance, fair share of tax, of course, and do not hesitate to contact us. Then thank you for the very numerous attendance. More than several hundreds were joining today, so I believe it is proof that it is a required webinar, and we'll keep up this tradition. And whenever new tax legislation is coming out, then we are informing throughout the newsletter and making a webinar as well, as at least once per year, and this year also during summertime as well. So that's probably all. Maybe Kristjan, if you have a minute, Urzula, I see a question about fresh court practice regarding change in interpretation of taxation of non-monetary contributions. Is this something you can answer on the spot, or maybe follow up afterwards?
It's not, we can't rely on the changing core practice. It's been a changing interpretation practice of tax authorities, and it's something that could lead to
court practice.
Court practice,
Yes.
hopefully. But in short, there are some some loopholes, so to speak. But in the current outcome, in short, is that and the message also from authorities that please be prepared in a way that if you are even before you are thinking about selling your shares, please start the reorganization.
All right, thank you, everyone. See you next time, then hopefully soon.
Thank you.
Goodbye.